Yes, Ritika.
Okay. So good evening, everyone. So this side CA Nikita from Sonipat area. So I'm associate member of the institute. So I uh, first of all convey my gratitude to the CASA team for organizing such sessions for all of us for our benefit. And I welcome you all in today's webinar, which is going to be on the topic relating to international taxation. So as we all know that we had two technical sessions yesterday, which were about residential status and total income, dividend interest, and fee for technical services. So today also, we are going to have two technical sessions. The first would be from 4 p.m. to 5:30, and that would be regarding technical issues relating to business connection, permanent establishment, and significance economic presence. That would be taken up by Ritika Goyal ma'am. So before proceeding to the technical session, I would like to brief you all about C. Ritika Goyal ma'am. So she is a qualified chartered accountant of November 9 batch and she's been AIR 30 and she has 14 years of post qualification experience in the matters relating to international direct tax, and she leads international direct tax practice of HCL Technologies, which has global presence over more than 60 countries. And her work profile also includes managing compliances, tax assessments, drafting and implementing internal control, internal transfer pricing, along with global tax advisory. So I believe that we will be getting a lot of knowledge regarding today's technical sessions topic. So now I uh, welcome Ritika Goyal ma'am. Please take up the technical session.
Yeah, hi
Uh,
Nikita. So much.
Ritika, before you start, Sachin ji, you want to add anything about the today's topic?
Okay, so thank you so much, Kasa, for giving me again this opportunity to give the overview of the session before starting the session, because
Yes, that
as
is
you
required by you.
as Nikita has already given the yesterday's small brief that that session was relating to total income, residential status, and the taxation of interest, royalty, FTS, etc. And of course, I must say that the session was excellent. I don't know whether you have realized or not that all the four speakers are female member of ICI, and all the moderators are also female member of
Female
ICI.
members.
And so today's session is also very important. It's divided into two parts. First part is in respect of permanent establishment and significant economic presence. And the second part will be taken by Smita Patni ma'am, and that is on the issues of 15 CSCB and Section 195, so all practical issues. So since Ritika has expertise in the corporate level, so she can give us the input of the other side. As a consultant, we generally see the one way of the transaction, but Ritika can give us the other input also. So we request her to give the practical aspect of the transaction. And since the topic is very important, because most of us are not able to understand when it can be said that the permanent establishment is situated or not. So if she can give us some practical examples to understand or to clarify these situation, then it will be great helpful for us. So thank you so much, Kasa, for giving me this opportunity.
Thank you, Sachin ji. And Ritika ji, Nitika would be the would assist you in asking the query from the participant,
Mhm.
if any there. Now you can take up your session. Over to you.
Yeah, thank you. Thanks, Sachinji. Thanks, Sumit, and thanks, Nikita, for introducing. So, as Sachin has mentioned, that I am not from consultant background. I am more from business. So, in last 14 years, entirely I have worked with HCL in international taxes. So, I have looked at the transactions from business angle instead of from the consultant's angle. So in my session, I will not discuss the case laws or the legal definition of the um, provisions written in the income tax law. Rather, I will discuss more from the practical standpoint. So I'll just share my PPT. So it's a very simple PPT. There is nothing legal jargon into that. So I'm not sure how to share on Zoom. Just a minute. Okay. My apologies. I am not used to using Zoom. So
No problem.
to share
On
this,
display share screen आ रहा होगा रितिका.
नहीं शेयर स्क्रीन में ये ऑप्शन दिखा रहा है वन पार्टिसिपेंट कैन शेयर एंड मल्टीपल
Just a minute. Just a minute. Just a minute. Now check. Now try to share.
नहीं इसमें तो नहीं दिख रहा है.
आना चाहिए. आप एक बार अगेन ट्राई करिए. शेयर स्क्रीन कीजिए.
हम्म.
ओपन हुआ.
एक सेकंड. Okay, it's entire screen.
Or you can share that PPT only as well.
So let me know when my screen is visible. I think now I'm able to.
नहीं बिल्कुल perfect. It is coming.
Acha. So help us start with the global tax systems which we have globally. One is the residence-based taxation, one is the territorial-based taxation. So generally, countries are divided into two type of tax systems. Most of the developed nation, if you see, they use residence-based taxation because initially they used to be capital-intensive jurisdictions with a lot of capital as well as labor and machinery at their disposal. So, under the residence-based taxation, the residents are taxed on their global income. So, most of the big business houses were based in those countries, so they opted for the residence-based taxation. And the non-residents are taxed only on the income which is attributable to sources in those countries. While in the territorial based taxation, residents and non residents are treated alike and they are taxed only on the income which is sourced in that country. But the only difference which is there in the resident and non resident taxation in the territorial taxation is that residents are taxed even on the income which is exported out of that country if services are performed in that country. But non residents are taxed primarily only on that income which is sourced in that country. But in India, if we look at India, how India has opted for this tax system, so India has primarily taken base from residence taxation, but it has also added the remittance based taxation. So, remittance is all the features of residence taxation, that is, residents taxed on global income, non residents on their income which is sourced in India, as well as if income is received in India or deemed to be received in India, that is also subject to tax in India, even if the source is not in India. So that's the uh, hybrid which India has brought in into its tax system from the global tax systems. Now moving to the how business has evolved over these last 70-80 years, and that's how the concept of business connection, permanent establishment, and significant economic presence has also evolved. So traditionally until 1990s there was no you can say there was no service industry in place. All the companies were primarily capital intensive companies where the goods were being manufactured and companies used to deal in the tangible goods and properties. And the offices used to mean the brick and mortar presence. There has to be a fixed place of business, fixed place of office, whether it's a factory, a warehouse, or a branch office. Or in there, the business which they used to do through those offices was for the tangible property. Tangible is goods or anything which is not considered as good but which you can touch and feel. And there has to be some permanence because when we say that the business is done through brick and mortar model, then there is a permanence involved into that. There is an office, you are continuing operations in that office for an extended period of time. So that's how the business used to be done. And accordingly, if you look at the OECD model convention for tax treaties as well as the US model and UN model, when the original treaties were drafted, they only kept into mind the capital intensive businesses, and accordingly, the definition for permanent establishments were incorporated into those treaties. The Article 5 primarily took care of only fixed place of business type of business models. But as we moved forward from 1990s onwards, the service industry started emerging. So there were IT companies which had come into existence. There were other business models which were more service driven. They had come into existence. So then the tax authorities of different countries realized that the business with the taxation system which they have defined in their domestic law as well as in the model conventions, that is not sufficient enough to tax the profits of the service industry. So they brought certain changes into those conventions or the domestic provisions. So, for example, in India, the definition of business connection was added, and it was expanded to include even the services and income accrued or deemed to be accrued in India, and there was a detailed definition given for that. Similarly, in other countries, in USA, in Canada, they came up with the concept of the income which is effectively connected, or there's a business nexus. So they use two terms. One is the effectively connected income. This other term is um, business nexus. So if you are providing any services into that country, there is a base in that country where you are using the infrastructure and the facilities of that country, then a nexus is being created and accordingly you will be taxed in that country. So they brought certain changes, and similarly the conventions, the model conventions were also modified to include um, the provision of services into those treaties. Then after 2010 and 2015, we saw that the service industry, specifically the digital economy, started emerging into our day-to-day lives, and it also started accruing a lot of generating income for companies globally. So then countries again realize that the tax system which they have is not sufficient enough. So you must have read about the news of Facebook, Google, LinkedIn, um, in global news, that they are not paying the taxes, the moral taxes which they should pay in their country, and they are diverting the income to low tax jurisdictions where the laws are very liberal and they are allowing the owning of IPs into those countries. So all the income was being diverted to those countries, whereas the user base as well as the revenue is being generated in other countries. So the source of the income is lying somewhere else, but income is being diverted to the country where the tax rate was quite low. So then OECD had come up with the BEPS plan, base erosion and profit shifting. So I think the original discussion had happened in 2016, and now they are coming up with, so they came up with the action plan 1 to action plan 15 to curb or to divert or to bring back the profits to the country where those actually need to be taxed. But then, since these action plans were not being um, implemented by different jurisdictions in their domestic law, so they are now coming up with pillar 1 and pillar 2, through which globally the profits will be taxed in the country where the fair share of services or the fair share of market is based. Now coming to this, this is from an India perspective. So in India, we are not using the definition, the word permanent establishment. Rather, the term which is being used in section 9.1 is business connection. And business connection is a very wider concept. It and permanent establishment and significant economic presence are subsets of it. Because um, if you look at the definition of business connection, I'll go to the definition. The explanation 2 of section 9.1 states that any business activity carried out through a person who acting on behalf of a non-resident has or habitually acts as an Indian authority to conclude contract, habitually maintains in India a stock from which he regularly deliver goods or merchandise, or habitually secures orders in India. So it's a very wide definition wherein if a person is an authority to negotiate and conclude contract, the person may not sign the contract, but he has the authority to negotiate and to finalize the deal of the deal with the customer, and he can take a conscious call whether to go ahead with the bid for this customer or to back off from the deal. If that authority is with that person and the person is based in India, then that company or that taxpayer non-resident will establish a business connection in India. Similarly, if you are maintaining stock in India and that through that stock it is not just a preparatory or auxiliary activity, through that stock you are also securing orders and you are delivering goods so to the end customer, then also you have, so that activity cannot be termed as the preparatory and auxiliary in nature, and you have created a business connection. So business connection is nothing but a business nexus per se. And lastly, it secures order in India. But if you read the definition, there is just one exclusion, and it only talks about the independent status agent who is not included into business connection. But if an activity is preparatory and auxiliary in nature, that exclusion is not being provided in the definition which is being there in the income tax act. But if you look at the jurisprudence which is available through which this concept is largely settled in law, there they have defined this term taking cognizance of the permanent establishment definition from the model tax conventions. Coming back to the same slide, in the tax conventions, the permanent establishment definition. So in domestic law, they talk about business connection, but in treaties, they don't use the word business connection, rather, they define permanent establishment. And permanent establishment is the subset of business connection because it only take care of a few activities which are covered under business connection. So it's a fixed place PE. Fixed place means there has to be a place of business and the activity is being carried out for with a profit motive, and there is a permanent, there is a commercial and geographical coherence. So then you can say there's a fixed place PE. Then talk about service PE where there is a frequent travel of employees from one country to another country without transfer of payroll from the host country, from the home country to the host entity. So whenever employees travel from one country to another country, there has to be an entity who sponsors visa for those employees traveling abroad. So if employees are traveling, there has to be a domestic entity who is sponsoring. If employees continue to come without a proper sponsorship and they continue to be on the payroll of their home entity, and the payroll is also being processed by that entity, and they receive directions from their parent employer instead of from the host employer, then the home entity will constitute a business nexus in the host entity, and it may create a P for that home entity. So we can discuss it with the help of an example. Further, construction P is where you are so there may be some installation project or the construction project. So generally most of the treaties, because it's more related to the capital intensive industries, so if there's an installation project or a construction project where the activity is being carried out in the host country for an extended period of time, generally tax treaties provide for a 12-month duration, then the time period will be considered as long enough to create a business nexus or a permanent establishment for that entity in the host country. Then the agency PE, that is like You do not have your own operations in that country. You are using a third party, and the third party is working exclusively in accordance with the directions which the other entity is providing. For example, there's an entity in USA. It wants to avail certain services in India. Instead of sending its own resources to India, it appoints another third party and it says that you work exclusively for me. You, whatever work we will ask you to perform, you perform those activities accordingly, and we will remunerate you on this basis. So that agent is not now working into independent capacity. It does not have any other customer. It does not apply its own objective judgment to provide the services. Rather, whatever the other entity, other country's entity is asking it to perform, it performs those services and gets remuneration accordingly. So in this case, even though it's a separate entity legally, but since it is under the influence of another entity and work accordingly, so that entity will not be treated as the permanent establishment of that foreign entity. Now, significant economic presence. So, in the traditional definition for permanent establishment, nobody had visualized that there will be a digitalization in 2020 or 2015, and there will not be a physical nexus. So, when we say physical nexus, even in the capital intensive and service industry, there is a sort of tangible nexus. Either you have a physical office in that country, or you have an agent in that country, or you are sending your resources to perform services physically in that country. But when we talk about digital permanent establishment, that entity may not have any tangible nexus, in the sense all the value which is being created for the services which they are delivering, the DEMPI function, the development, enhancement, maintenance, protection, and exploitation. Everything is being done in some other country, but whatever is being developed, the intangible which is being developed, through that intangible, you are capturing the market of any other country. So, um, I'll take an example of LinkedIn. So, LinkedIn has its servers in US. All the data which they are hosting, those that data is being hosted on US servers. That data is being developed, that platform for LinkedIn is being developed, maintained, and enhanced timely by engineers who are seated in US. But that platform is being used to capture market of different countries. So server, that is a tangible thing, it is in US, resources are in US, intangibles, tempi function is being performed in US. So all the value creation and everything is being done in some other country. But when we see the revenue of LinkedIn, that revenue is linked to the users in different country, the market jurisdiction which we say. So when we read pillar 1 and pillar 2, so there is a concept of market jurisdictions. And the market jurisdiction is where you are hosting your server, and through that hosting, you are generating revenue. Like Netflix. In Netflix, they are selling the content in India, and we are subscribing to that content by paying a monthly or annual rental to Netflix, and that revenue, the more user base they have in India, the more revenue they will generate. So, from a traditional business connection and permanent establishment standpoint, they may not get caught under the tax purview, and they may say that if you read the law as is being defined, I'm not getting covered. My activities should not be taxed in this country. Rather, my activities should be taxed in US or in Ireland, where I'm actually performing services or where I'm owning my IP. My IP is being owned by my subsidiary in Ireland, and significant people functions are being performed in USA or in Ireland. So my income should be attributed to these two countries only instead of anything being attributed to India, because India does not have any right to tax this income. So tax authorities realize that digitalization is the today's way of doing business. So we'll have to bring this way of business into TaxNet, and how they can bring this into TaxNet. So globally, there have been talks. OECD is working with its different working committees and is coming up with action plans, and they are also working on Pillar 1 and Pillar 2. But in the meanwhile, we are losing revenue. While those guidelines or those conventions are being signed, it will take some time those to roll out and in domestic law to bring changes, to accept or to implement those conventions. But in the meanwhile, to capture share of taxes in the revenue which these companies are generating by having digital connection in India, India brought the concept of significant economic presence into their definition of business connection through explanation 2A. So I'll just read the definition. It's an exclusive definition because it says it shall mean um, significant economic presence shall constitute business connection in India, and significant economic presence for this purpose shall mean transaction in respect of any goods, services, or property carried out by a non-resident with any person in India. So they are not saying in India. So the activities are being carried out anywhere across globe, but the party to that transaction is in India, including provision of download of data or software in India. If the aggregator, so now they are saying that we have defined that yes, you have created an business connection if you have a transaction with a user in India. But at what point it will be said that you have created a significant economic presence? So there has to be some threshold which need to be defined. So initially, they just, while they brought this provision, they just mentioned that the amount as may be prescribed. And the second point was systematic and continuous soliciting of business activities or engaging in interaction with such number of users in India as may be prescribed. And this provision of significant economic presence was not implemented until 2020 to 23. So in 22-23, they brought Rule 11 UD, through which they defined the actual threshold for the transaction for the revenue amount as well as the user base. So certain transactions in the digital economy are user driven and certain transactions are revenue driven. So if we talk about aggregators like Amazon or your Flipkart, Mintra, I'm not sure if they all are global ones. So their revenue is more revenue driven. So their transactions are revenue driven because they are aggregator. They are providing a platform to vendors as well as the buyers. The vendors register on their platform, and the user buyers through that platform purchase goods and services from Amazon. And the Amazon's profit is the commission which they receive from the vendor for providing that platform to that vendor and the buyer. So the law says if the total revenue of these aggregators or these online service providers exceed 2 crore rupees in a year, then that transaction or that entity will be treated as having a business connection with significant economic presence in India, and that transaction will be subject to tax in India. Similarly, if the transaction is not revenue driven, rather it's a user base like Netflix or LinkedIn. So there, if your user base exceeds 3 lakh in totality, then you will be considered to have significant economic presence. So if you see the income tax return form for financial year 22-23, in the first page itself, there is a um, new, I think, clause which is being mentioned. Do you have a PE in India? If you have a PE, you can mention yes, and then accordingly you will fill in the form accordingly. The next point is, do you have a significant economic presence in India? And then these two conditions are laid down in the form itself: total revenue base and the total user count. So you have to mention those limits in order to let the tax authority determine also what is your user base and what is your revenue, and whether you are crossing the threshold to be considered to be taxable in India. So that's how they have brought this change. So this is the domestic way of um, getting digital transactions into TaxNet. Different countries have opted for different means, like Taiwan, Korea, Japan. They have also come up with the unilateral measures to tax digital economy in their domestic law. But as I understand, the game plan is the moment this pillar 1 and pillar 2 will get implemented. So pillar 2 is not related to digital economy taxation, rather pillar 1 is. And in pillar 1 there are two amounts, amount A and amount B. Amount A is that where that entity is having its base, so 10% of the base return on the total capital which it has invested in its business will be treated as a normal return, and whatever profit it has earned over and above the 10%, 25% of that profit will be attributed to the market jurisdictions in the ratio of the revenue base or the user base. So if let's say Amazon has a total profitability of 25%, so 10% will be with the US because it's US based company having made investment in US, so its capital is in US. The over and above 10%, that is the balance 15% margin, 25% of that margin will be distributed among the market jurisdiction from where it is generating revenue. So that's how they plan to bring pillar 1, but the companies which will get covered under pillar 1 are very big companies, because the threshold is if their turnover exceeds $20 billion. So only very few big fishes will get into the tax net of pillar 1. But the Indian government is still evaluating whether they should continue with the domestic way of taxation of this digital economy, or they should opt in for pillar 1, because the moment they agree to implement pillar 1, they'll have to just abolish these domestic provisions and will tax only under pillar 1 provisions. And as far as I understand, based on our discussions, India is generating around 5,000 crore of revenue from digital economy taxation, and it is evaluating whether it will be generating over and above 5,000 crores through pillar 1 implementation, or it will be at a loss. And basis that, I think they'll make a conscious decision. So I'll take a pause here. Maybe we can take a few questions and then we can proceed. Yeah, so
So I request all the participants, if they have any query, please keep it in the chat box, and Ritika ma'am will be answering the same.
So can I ask one query?
yeah, sure, sir. Go ahead.
So, Ritika ma'am, like SCP, there is a similar provision in respect of equalization levy also.
Mm-hmm.
So since SCP is already there, so and if the entity or the transaction is falling under both the head, like SCP and equalization levy, which will apply first?
So, sir, though I am not being very thorough in equalization levy, but as I understand, when we read the equalization levy law, they have mentioned that if your transaction is getting covered on Income Tax Act, so I think then equalization levy will not apply. So I think the preference will be given to SEP over equalization levy. And I think that should be the intent of the foreign taxpayers as well, because equalization levy, they will not be able to claim any DTA benefit. Besides, um, the tax percentage is fixed, so it's 6% to 2% under equalization levy 2.0. At the percentage is 2%, and the first one it is 6%. But under this SEP, you will be paying taxes on net basis after deducting all your expenses and providing for your penal computation. And on that net profit, you will be paying taxes. So, to my understanding, this SEP provision is more beneficial for foreign taxpayers, and even the law also provide preference to SEP over and above equalization levy.
Okay. Thank you so much. So one more practical question, ma'am. While doing transaction or while making payment to YouTube, let's take a simple example of YouTube because everyone is using YouTube. So how do a payer can come to know that whether the SEP is there or not?
Um, So I think it's the foreign entity will have to. So, frankly, I do not have much visibility into this question, but I'm just guessing that is the foreign taxpayer will have to make a declaration that they will be taxing their income under SCP under income tax provision, and equalization levy should not be applied on their remittance. Because in so not about this equalization levy or this digital economy, but even globally also, if you have a permanent establishment in that country and you also have certain activities which are not related to a permanent establishment, so then generally the taxpayers make a declaration to their customers that we already are registered for taxes in this country, we are filing our tax return, so we'll be paying taxes on net basis in this country, so you please do not deduct withholding taxes. So that's how globally the tax authorities and the tax systems operate. So there are specific forms which are being prescribed by different tax jurisdictions wherein the non-resident taxpayer can make a declaration for making choices. So I'm not sure if because my um, India taxation is not as strong as my interplay in international taxes. So but yes, I can check and I can get back to you, sir. So we have certain vendors on whose payment we are deducting equalization levy and we are filing. So I can check with our internal teams and get back to you. So how actually they are doing this.
Ma'am, there is one more question from Love Sharma. It is, if the non-resident company does not check its digital PE, but
Mhm.
share that no PE certificate to the Indian company on their demand, and on such certificate, Indian company transacts and paid the foreign company. So who will be in default and what will be the consequences?
So if we talk about equalization levy, so there are two, I think, acts. One is equalization levy where 6% is applicable, and the 6% is it is the recipient of the service who needs to make the payment. So even if non-resident uh, has not made a declaration, so that non-resident will not be at default. But under equalization levy 2.0, it is the non-resident who need to take registration in India for equalization levy and file its and pay its taxes. It is not the recipient of the service or the payer of the service who is required to do anything. So that's how equalization levy is concerned. About this SCP, so if we talk about India Income Tax Act, so for that SCP, then we are not required to deduct taxes if the person has not made a declaration that he does not have a significant economic presence. He shares the TRC. He mentions that he does not have a P. Then, as a um, service recipient, I will rely on the document which the non-resident has shared. So I will not go beyond that document to question whether you have and I do not have any locus standi also. I do not know how many user bases that non-resident has. Similarly, I am not privy to the fact how much revenue that non-resident is earning in my economy. So that is something which is privy to only that non-resident. They know their user base in India. They know
हाँ
their revenue in
रितिका
India.
जी, आई थिंक आपने स्क्रीन शेयर की हुई है, तो वो हमारी फोटो वापस आ रही है।
Acha, sorry.
हाँ
Sorry.
राइट, नाउ नाउ ओके, नाउ ओके।
Okay. Okay. Sorry. Yeah, so what I was saying is, so this information anyways is not available to the payer of uh, that non-resident. So not only in this particular SCP transaction, even otherwise also. So if we are taking services from a non-resident who is sending its resources in India to provide services, although I may know that the non-resident may have created a permanent establishment. But if non-resident takes a position that no, I do not have a PE in India, he may have a basis to contend that he or she does not have a PE, then I cannot question that unless I have concrete facts and through which I can counter to the non-resident that no, you have servers in India, you have tangible property in India, you are selling goods in India, and we have this information and we cannot agree to your statement. So in general, we rely on the documents which non-resident is sharing.
Okay, thank you, ma'am.
Yeah.
So I think there is no other query in the chat box. We can proceed further.
Okay, so now I think I'm not covered much content, so I'll just come to this P challenges into this. So we discussed that in general, the word P, how it is defined in the tax conventions, it generally talks about the fixed place of business, which has multiple elements. So the definition says a non-resident carries on activities in the other jurisdiction with a profit motive. So there has to be a place of business. It can be owned, it can be rented. It is a lease. It can be a leased office or illegal also. So the income tax law does not differentiate between legal and illegal. If you have presence, then you will be taxed. You will be brought to the tax net. There has to be a certain degree of permanence in the place of business, which we discussed. That the business should be carried out through that place for a extended period of time so that you have an enduring advantages and it has to be at your disposal. So I'll just take an example of a service contract. So let's say there is a company in Netherlands, it sends resources in India to provide some activities or some services at a client location in India. So the client has its offices in India and those resources are required to be present in India for, let's say, 60 days time. So those resources, since that foreign entity does not have a place where those resources can sit and perform services, so they'll sit in the customer location. So customer can provide the space which is designated to those for those resources. It can provide a meeting room and it says that you keep working in this meeting room and it is at your disposal. So I'll not interfere into the activities you are doing. I just need the services to be delivered by the end of this time. So from that premise or from that meeting room, now since it is at the disposal of the foreign entity resources, they may work exclusively for that client or they may also work for another client. Company may choose to also secure orders or do business development through that conference room which is being provided by the client. So that office, even though it is a client premise, that and you are working from that office for an extended period of time, and it is resulting into the more business for the company. So that office space will be constituted as a place of business for that foreign entity for the purpose of permanent establishment. In the other example, if let's say the customer says that it's a very regulated region, you cannot do any activity even if you are working from my premise, your machines will be under my supervision and you will be working only on my software. And in fact, sometimes what client does is they provide their own email ID. So they say all the email exchanges due to confidentiality reasons will be sent on that new email ID of those employees while they are working in client premises. So that's a regulated um, place of business, not at the disposal of the foreign entity. So in that case, that foreign entity is just delivering services for that client from that office, and it is not generating any other benefit from those premises. So in that case, unless the presence of those employees is long enough to create a PE based on time, there will not be any permanent establishment because the place of business is not at the disposal of the foreign entity. So there has to be profit motive also. While you are doing the activities through a PE, it should not be like you are doing something but it is for NGO or some other thing, then there is nothing to attribute. Even if you conclude that you have a PE in a country, you do not have anything to attribute because there is no profit being earned in the overall transaction which is being delivered. So, yeah. So, in the general exclusion which is being provided is your preparatory and auxiliary services and the maintenance of a space for preparatory and auxiliary activities are not to be considered as part of permanent establishment. So now the questions are there are different type of PEs. So every PE definition need to be evaluated based on the facts of that case, and each entity's facts are different from the other entity's facts. So there are certain set of facts where the controversy is more. So I have just mentioned a few of those, but I'll just keep it open for everyone to ask if they have any specific facts which they want to discuss. So one is forwarding offices with no real business. So sometimes global entities, what they do is they just want to have a presence or an address in a country to show to their customers that they have presence in a country. For example, Indian entity signs a contract with a legal firm in Netherlands just to use the address of that entity on their letterheads as well as in their on their website that they have presence in that country and they can secure contracts locally. So will that forwarding offices where there is no resource, that office is also not at your disposal, will be treated as a permanent establishment? So in general, it should not, because there is no real business which you are doing from that um, from by using the infrastructure and the facilities of that country, or even otherwise no activity is being performed from that office except for using the address of that country's company. So there are a lot of case laws globally where they have unanimously um, concluded that forwarding offices where no actual activities are being performed will not be treated as a permanent establishment and there should not be any attribution of profit. Other one is online sales warehouse. So there is a company which sells goods and service goods online. It has its office in USA or some other country, but it has its warehouse in India. So the goods are shipped from US. They are um, they reach India and then they are warehoused in India against the orders. There are people seated in India who um, get the custom clearance done and then they pack those goods and they send those goods to the end user who actually ordered it online from that US company. So will that warehouse be treated as a permanent establishment of that US entity? So if we read the PE definition, there is an exclusion in clause 4 in the tax convention which says the maintenance of preparatory and auxiliary office warehouses or stock will not be treated as a constitution of PE. But in this warehouse, it is not just you are maintaining stock. You are maintaining stock, you are also having resources who are packing, unpacking, and if there is a return, they are also receiving the return of those goods, and then they are also delivering to the end customer. So the activities which that warehouse is performing is not of preparatory and auxiliary nature per se. Rather, it is like a sales and distribution function which it entirely performing for a non-resident in India. So in that case, that warehouse will be treated as a permanent establishment and the profits will be attributed. Remote workers. So after this pandemic, I think this has become the truth of the day that nobody works entirely from office. So there are a lot of people who were being hired during COVID days with the offer letter wherein it was stated that you are not required to come to office. Your work location, you can work from anywhere across the globe. In fact, companies globally have hired people who are not uh, in their country, rather, who are based in different countries and they are not even required to travel to those countries. So, for those remote workers who are working primarily from their home location, how the activities of those remote workers will be treated from a PE perspective. So there have been a few judgments, recent judgments of Denmark courts and Netherlands courts, where they have said that the activities need to be evaluated based on the functions, people function which they are performing, whether they are significant people function, whether they are critical enough to um, affect the productivity or the um, business of the company, then the presence or the location of those resources will be treated as a permanent establishment for that foreign entity, even if that work, that place of business, from place of work, if they are working from home, they are working from hotel, or they are working from any other location within their hometown, is not at the disposal of the foreign entity. So the foreign entity may not have control over the space, but the individual which they hired in different country, the functions which that resource is performing, how critical those activities are for the business of that foreign entity, basis that they will evaluate and they will determine whether it will constitute a PE or not. Um, Cloud server hosting services. So, in today's time, I think companies are more interested into getting transferring their um, capital cost into variable cost. So instead of buying servers and capitalizing those in their balance sheet, what they do is they do a tie up with other companies who provide space on their servers for hosting their content. So that is called cloud server hosting services. So the server may be located in different countries. In those countries, the data of an Indian entity or any other country's entity is hosted in on that server, and accordingly the services are being provided. So the question is, if the server is not located in that country and the services are being provided through the data which is hosted on those servers, then whether the P the permanent establishment will be considered as being created um, in the country where the revenue is generated or where the server is hosted. So globally, tax authorities have come up with the concept that The server location is not relevant in today's way of doing business. Rather, they are coming to the digital taxation only. They are saying wherever you are generating the revenue and the activities for generating that revenue are being performed, those two jurisdictions will share the respective share of taxes. And the attribution is something I think they will have to work out, and it varies from country to country and the domestic provisions. But the next one is the staff augmentation services. In the staff augmentation services, but the real business model is the legal employment stays with the entity who has employed the resource. But the economic employer of those resources is another company who is actually exploiting the services of those resources. So let's I'll just take example of my company HCL. So let's say HCL has signed a contract with a customer, and the customer says, I need engineers with this skill set, these number of experiences. So HCL being an IT company, so it already maintains a pool of bench, and it also provide training to its resources. So what it does is, based on the customer requirement, it provide resources. But customer says, I do not want those resources to be put on my payroll. There may be certain local restriction. There can be immigration restriction. For example, in Mexico, there's a restriction like you can hire one expatriate against 9 local resources, not more than that. So the customer says, I already have exhausted the limit for from an immigration perspective. I have 9 local hires, one foreign expatriate hire, so I cannot have more resources on my payroll. So I don't want these resources to be legally transferred or the to my company. Rather, I want you to continue to be their legal employer, but the services they whatever work they will perform, I'll be the one who will be responsible for the risk and reward of those services. If they perform good, I'll be the one who will be rewarded. If they do not perform, then I'll be at the risk of their non-performance. So what SCL will do, it will keep the legal employment of those resources, which means that SCL will continue to process the payroll of those resources in India while they are on deputation to Mexico client. They'll work for the customer on customer premises based on the day-to-day supervision, direction, and the control of customer. I will not have any say into what activities customer is getting done through those resources. Those resources will receive, so apart from the salary, they'll also receive the on-site allowances. So the on-site allowances are also being provided by HCL through a travel card. It keeps on updating those travel cards, and those resources come back to India because India being the legal HCL being the legal employer once the customer's requirement gets over. So, and HCL gets some remuneration for performing this administrative function of keeping the legal employment and transferring money into employees' bank account, monitoring the travel cards and the balance being maintained in their travel cards. So, and the margin is generally ad valorem. So, if the salary cost is $100,000, it's let's say 5% of that. So, will the activities which SCL is performing, being the legal employer, so SCL continue to be the legal employer, SCL is sending resources in Mexico. So, the Mexico tax authority may say that you are the one who is owning those resources. These resources are staying in my jurisdiction for an extended period of time. And even if they are not staying for an extended period of time, so there are two factors. One is either you are sending 1,000 resources for 10 days or you are sending 10 resources for 100 days. In both the cases, it will be considered as a significant presence. So it is not only the time which matters, sometimes it is the volume also matters. So you have created a business nexus in my country, so you need to pay taxes to my country. So the activity which HCL is performing is the staff augmentation, is the manpower supply services. with a small margin being earned on those services. So, technically, yes, India has created a permanent establishment with the continuous presence of its resources in Mexico, but sometimes it is not the question of creating a PE. It is about the attribution of profit, whether I really have sufficient profits to attribute, whether the local authority will be interested enough in pursuing my case, considering the volume of profit I am earning on those activities. So, staff augmentation services generally do not constitute P from a practical standpoint. Although technically, yes, they may create a P, but practically, businesses do use this route to circumvent the P creation as well as attribution of profits. So these are certain, I think, um, technical P concepts where based on facts and the based on, in fact, in all cases, it all depends on the facts of the case and how you are presenting your facts. So whenever there is a question relating to the PE, business connection, or significant economic presence, it is not the law which really helps much. It is the facts. So, what facts you have in your case and how you have created the documentation around those facts. So, sometimes, although the way we explain the facts to the tax authority is how you are operating your activities in a country, but the documentation which, because facts need to be supported by documents, so if you have created the documents which are not clear enough or which are not worded clearly, there is a vague language, or um, you have not defined anything in relation to the roles and responsibilities of different parties to the transaction, then those facts may not support the argument which you are putting forward, and accordingly it may lead to bad judgments also. So I'll again take a pause here.
Yes, Ritika.
Sorry.
आप स्टॉप शेयरिंग कर दीजिए एक बार. हाँ, श्योर.
अच्छा हो गया क्या?
हाँ, हाँ.
अच्छा ठीक है. ओके या
You can take a query. I think chat
Yeah,
box.
sir. We have one query from Arvind Singh.
Yes.
Ma'am, this is in case where one project is awarded by foreign entity to an Indian company, some part of the project are being done by Indian company, whereas some part of the project are executed from a PE of the Indian entity. Then whether the transaction which are made from Indian entity are being treated as profit attributable to the PE.
No, so Nikita, I didn't get the question clearly. So you're saying
Ritika, you can alternatively you can read the query in the
Chat box, yes.
the chat box में तो मुझे नहीं है. रुकिए एक सेकंड.
Just
If you go,
Arvind,
then yeah,
yes,
it is
yes,
from
yes.
Arvind Singh.
is awarded by foreign entity to an Indian company. Some part of the project are being done by Indian entity, whereas some part of the project are executed by a P of the Indian entity. So the where that P of Indian entity is based out?
I think better to ask by.
And it's that
So I request Arvind Singh ji if you can
Arvind ji, are you there?
highlight.
You can ask your query.
Yeah, it is outside India, ma'am.
Yes, yes.
okay.
Thank you for the opportunity. My query is, suppose one project is being awarded to an Indian entity. Some part of that uh, are being executed from the Indian entity, the which entity we got the contract from the for some part of that project, that Indian company created a Indian company create fee in that foreign country, and he is doing that part of some part of the business in that foreign country. My question is the, the transaction between the Indian entity to foreign entity directly, whether that in transaction of Indian entity will also form part of will also be treated as a profit attributable to the fee which is located outside India.
No, so Arvind, yeah, let me just rephrase just to be sure that I understood it correctly. So there is a foreign entity, let's say it is based in US. It has awarded a contract to a company in India, which is an independent entity, right? And that Indian entity has a PE in country Y. So the work is being performed by Indian entity. Indian entity not only performs that activity entirely in India, but through some of its resources who are based in its PE in country Y, right? So now you are saying the transaction between the foreign entity and the Indian entity will be treated. I mean, how the
Yeah,
profit will be
once
attributed.
suppose I'm taking example in the US. Suppose a US government has given a contract to an Indian company. Now, what
Mm-hmm.
Indian company is doing, Indian company creates a fee in US for some part of the job of that project, and some part are being done from that Indian entity itself. My
Mm-hmm.
question is that transaction between the US and Indian entity will also form part, can be treated as a profit attributable to the fee located in US.
Yeah, so Arvind, it's a very good question. And we do have a lot of transactions similar to that in our company also. So there's a customer who is based in US. They have offshore, they have provided the contract to an Indian entity because they want to leverage on cost. And that Indian entity realizes that part of the work need to be performed at on-site. Otherwise, they want to, because there may be some knowledge transfer. There are certain user testing or discussions which need to happen at on-site with the team for customer based in US. So they set up a PE in US, and I think the resources are being located in US, and those resources are also performing some functions in US. So from a US perspective, whenever it awards a contract to a foreign entity, there is a form which you need to fill and share with the customer. There is a form W8 BAN and W8 ECI. So in the W8 BAN, it performs two functions. One is it provides the basic information of the entity, the name, the tax ID, and the um, jurisdiction where it is based out of. And the second is there is a portion in that form where you mention the mode of performance of services. So whether there is anything which is attributable to or part of the service are being performed in US or not. So if there is a part of service which you are doing in US, then there's another form W8 ECI. ECI stands for effectively connected income. So US law, as I mentioned in the beginning, it's a residence-based taxation. It says the domestic residents are taxed on their global income, but the non-residents are taxed only on their US source income. So unless the services are performed physically on the soil of USA, US will not ask for the share of tax in that income. So when you say that yes, I do have effectively connected income, which means I do have resources who are based in US and who are providing services on this contract, then I'll have to provide this declaration to the customer, and then customer will ask for additional detail about the portion of the total service contract which is being performed at onset and offshore. And you will have to say, let's say 80% is being done offshore, so 80% of the revenue is attributable to my offshore services which should not be brought into the tax net. 20% of the work is being performed in USA, or not in effort terms, rather in revenue term, because in effort term revenue will be higher. So 20% of the revenue relates to my activities in US. So on this 20%, I am providing you this form declaration in ECI, which means that I'll be taking registration with the US IRS, and I'll be paying my taxes on net basis. So you need not to do any tax deduction. So, but if you do not provide ECI, but you declare to the customer that um, I do have on-site portion of services, then under the US domestic law, there is a 30% taxation which will get attracted, and on this on-site portion, they will deduct this 30% withholding tax under US law and make payment for the balance amount. And if you have not made separate invoices for on-site services and offshore services, then the withholding will be applied on the total invoice value. So that's how it will be, I think, treated. So the declarations are very important, not only in USA, in fact, in any country wherever you are operating. So if you are performing services not only from an offshore location but at on-site also, it's always wise that you inform your customer that you have a permanent establishment in that country. You already are registered for taxes. You will be filing your return on net basis. So the withholding need not to be done, and you are taking responsibility for those taxes. Because sometimes the tax authority says that they, as per law, they make the service payer the collection agent. They say that if there's a transaction with the non-resident, then it's the payer entity who need to collect taxes from the non-resident, deposit with the tax authority. But if we provide the declaration, then the payer entity has something to demonstrate that there is an agreement and there's a declaration from the non-resident that I need not to do the deduction, rather they'll be paying taxes at the year end. And at the year end, they may ask for the copy of the return and the declaration which you have made, just to be on, just to be keep themselves safe.
Thanks, ma'am.
Any other query? Ritika, your session complete हो गया या if anything pending?
So practically, I think I have covered most of the concepts. So unless somebody has question, we can wind up this discussion.
Definitely. If any question is there, then I also welcome Smita Patni ji, second speaker of the session. Welcome to you. Before her speak, I request if you have any query, you can ask right now in the chat box or unmuting yourself.
I think there's one question from Love Sharma.
Sachin ji, you want to say?
Yes, Ritika ma'am, one more query I have. So presently we are facing a lot of queries relating to the server issues. So if the server is in India and the payer is also is in India, then how to test whether the P is in India or not?
So, sir, even though you have a server, so for what activities you are using that server? So, is it for the maintenance of your accounting database, or you are using that server to host the website through which you are providing services to the customer? So, depending upon that, I think the taxability of, or the creation of the permanent establishment will be established. So, from an Indian perspective, sir, I'll have to check and get back to you on this
Because
question.
nowadays, if you see AWS, lot of clients are making payment to AWS. We don't know whether the AWS server is in India or not. So in that case, how to satisfy, or in practical situation, how to deal with such type of cases where what kind of document we should obtain from the payer, so that as a consultant we can say that yes, or we can form an opinion properly.
So, from a legal standpoint, I think there are three documents which we collect. One is the TRC, another is the no PE certificate, wherein the declaration or the assessment whether they constitute a PE in India or not is with the customer, with the customer to confirm, and not with the payer to confirm whether they have a PE or not. And the third one is Form 10F. So if we have these three documents from the non-resident vendor, then we can make the payment without any deduction. But if they provide a declaration that they do have a PE and they'll be declaring their taxes on their own, then I think again there is no need to do deductions.
Okay. Okay, thank you so much. This is all from my side. Any other query? Manish ji, do you have any question?
No, sir, this is right. Thank you very much.
Thank you. So over to Nikita ma'am.
Thanks, Ritika, ma'am. for providing highlights on the topics PE, SEP, and business connection. So it will help us a lot in our practical life. So thanks again for sparing your time for all of us. Now the next session would be taken up by Smita Patni ma'am, and Miss Pooja Garg will be coordinating and moderating the session. Over to you, Pooja.
Okay, thank you. Thanks, everyone. Thank you.
Thank you, Ritika. Thank you.
Very good morning. Very good evening, everyone. Myself, CA Pooja
So,
Garg,
Pooja,
practicing chartered accountant. Yeah.
Yes.
And
Yes.
so it's time to cover the topic that is practical issues and challenges related to form filing, Form 15CA and CB. So it is truly and greatly honored to introduce our esteemed speaker, Ms. Smita Patni, a luminary in the field of finance and taxation. Ms. Smita Patni was enrolled as a member of ICAI in the year of 1999, securing 44th AIR in CA Intermediate. She pursuing her law from Rajasthan University, followed by Diploma in Information System Auditor, DISA, and Diploma in International Taxation from the ICAI. She also holds a certificate course in treaty, DTAA, Double Taxation Avoidance Agreement, with BCS University. Notably, she recently played a very crucial role in the ICAI publication on technical guidance note on fees for technical services and royalty. Background material for certificate course on UAE, and also she's a very honored direct tax committee member in the ICI for fiscal current year. In conclusion, Mr.